Welcome to Strategy Saturday. I'm Charles Carillo, and today we're going to be discussing recession-proof real estate investing. Have you always wanted to invest in real estate but didn't have the time, didn't know where to find the deals, couldn't get the funding, and didn't want tenants calling you? Since 2006, I've been buying income-producing properties in great locations that provide us with consistent passive income while we wait for appreciation in the future and take advantage of tax laws while we're waiting. And unlike your financial advisor, we invest alongside our investors in every property we purchase. Check out investwithharborside.com. If you like the idea of investing in real estate, if you like the idea of passive income, partner with us at investwithharborside.com. That's investwithharborside.com. Commercial real estate, especially multifamily real estate, can produce a consistent income stream even during a recession. However, not every apartment complex is recession-proof. The major benefit of investing in multifamily real estate is the flexibility it provides. Even if real estate prices fall or liquidity dries up, apartment complex owners are still able to ride out the storm with a solid source of passive income. In this episode, we will be exploring several steps from making a real estate investment recession-proof. You can refer to these steps when purchasing a new property or follow these steps to reinforce the fundamentals of properties you already own. Number one is maximize cash flow. I feel this is the most important. Cash flow is what pays your expenses, pays your debt, pays the limited partners. There are a number of ways to maximize cash flow, including bring apartments to market rent after a tenant moves. Also, I would avoid increasing rents dramatically on renewals. During a recession, I would rather have tenants paying slightly under market rents to avoid an empty apartment. Make-ready expenses and lost revenue is a huge expense when getting into multifamily real estate. The key is keeping your good tenants in your units during a pullback. Minimize full apartment upgrades. Now, this is all dependent on your renter base. If after you fully renovate a unit, you're able to rent it at full price, continue renovating them. And if there's still desire and demand for that, keep on doing it. In most instances during a recession, though, people would rather rent a clean unit that might be slightly dated for a lower price. This is also less risky for owners with a better ROI. For example, instead of spending $5,000 on a new unit upgrade to raise rents $200 per month, maybe spend $800 to $1,000 on painting and minor repairs in order to raise rents $50 to $100 per month. These classic units will rent fast in C+ to B class buildings. Last point on maximizing your cash flow is as your cash flow net operating income increase, your loan to value decreases. Of course, if cap rates expand, it won't decrease as much, but the point being, increasing your cash flow reduces risk, and it's the main step to making your property recession-proof. Second is reducing your debt. The lower the loan to value, the lower the risk. Prior to recessions, many lenders will push loan to values upwards of 90%, and these properties are usually the first ones to go back into receivership. As a recession looms, make sure your LTV is under 70%. And the lower the loan to value, the easier it will be to refinance if anything happens. Third is decrease expenses. Consistently review your property's expenses, put vendor contracts out to bid regularly, look into submetering water in your property, and after the submetering is complete, all new tenants and new leases will be paying for their own water and sewer. It takes about 12 to 14 months for it to fully go into effect. However, instead of raising rents on renewals, have them pay their own water and sewer. We just completed this on one of our properties in Tampa, where we were previously paying over $100 per month per unit in water. The tenants were paying a flat fee of about $50 a month, but they were grossly taking advantage of it. We removed the flat fee on the new tenants and renewals, and the tenants are now paying their own water. A savings that goes right to the bottom line. Fourth is increase additional income. So install coin-operated washers and dryers, install lockers and storage units and rent them out. Create premium parking spots and charge for them. These are all great ways of increasing income without raising rents. Fifth is buy properties in growing landlord-friendly states, cities. If you are looking for a mix of appreciation and cash flow, you should be buying in growing areas of the U.S. And this will help facilitate rent growth faster than other parts of the country. You might pay more for a property in a growing market than in a stagnant one, but you'll have less of a problem trying to rent in and less of a problem trying to raise rents. Now, during COVID, we had a small portfolio in a tenant-friendly state, and they were rent moratoriums for well over 1 year, with tenants taking full advantage of it. Once we could, we evicted them, re-rented the units, waited 6 months, and then listed the whole portfolio for sale. Who knows what tenant-friendly states will do during the next recession? They might enact another eviction moratorium, so it's important to reorganize and recognize that some cities in the U.S. still have COVID eviction moratoriums. Lastly, avoid investing into vacation properties or vacation areas. Areas where there is not a solid, diverse job market. Demand for vacation properties drops substantially during a recession, and it's usually one of the first areas to get hit hard. So I hope you enjoyed. Please remember to rate, review, subscribe, submit comments and potential show topics at globalinvestorspodcast.com. Look forward to 2 more episodes next week. See you then.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars LLC exclusively.